The asker asked a question during yesterday's macro show. That question if Q3's GDP number was higher than you expected, when that sequentially lower Q4's headline number, he thinks you misunderstood the question and defended the process, but he wasn't intended to knock your process at all. I just wanted to get a better understanding of the data.
Yeah, and I don't mind if people, I want people to challenge the process. I mean, we challenge you. If you could just have, actually maybe we'll just keep the camera on one day, and provided that it's not near the men's room, that would be tolerable as well. You could watch it. All we do throughout the day is challenge our premise, challenge the process. We don't hire people who come in and go, I believe in, and I'm going to accept everything that you say all day long. And that's not how we build it. That's not how we shake it, break it, try to change it, try to evolve it. So we appreciate it when you don't have to apologize for asking questions a certain way. It's very hard to offend me. But if you look at really kind of mapping what you just asked, which is the path of sequential GDP, because that's absolutely the question. So again, you have a rate of change. This is called a cycle. GDP, as you know, peaked at 3.3% in the middle of last year. How many times can I write this down?
Actually, it peaked in 1Q.
And then we come down here to 1.5% year over year, and now the call is, or at least the risk management exercise is trying to map between 1.5 and 0. It's unlikely that we get to 0 anytime soon, but it's very unlikely that we go to 2 or 3. Then you take the sequentials and you say, okay, the quarter over quarter number, Keith, however it had the fudgings in the number of 2.9%, that being higher only raises the probability that Q4, really Q4 in particular, goes down sequentially versus that number, okay? So that's what you're asking, and that's accurate. I think we're at 0.5 on sequential. Yep. So Q4 of 20, we're at equals 0.5%. So, forget James Comey and the FBI. What do you think Trump TV is going to be talking about after if he loses, for the next 3 to 6 months after he loses? He can't talk about the polls being wrong right now because it's the only thing that's keeping him alive, is that the polls are starting to go in his favor. So you don't hear him saying that. But you're going to hear him talking about how the government data was actually lying to the population with this kind of, effectively he's being accurate. If you're calling GDP 2 to 3% right now, you're lying to people. You absolutely are. So you don't have to be, you don't have to be expletive about that. You don't have to be emotional about that. It's just a fact. As we go into the fourth quarter, the probability is very high that you get a significant sequential GDP slowdown.
Yeah, absolutely. Do you mind if I grab that marker and join you?
Yeah, go ahead. Which colors do you want?
I'll take the blue.
Okay.
Looks pretty good. Seahawks color. So this is a very important modeling point. I don't know which camera we're looking at. This is a very important modeling point we want to make. This tells you all the information you need to know about the economic cycle. These are sequential data points like headline GDP or month over month auto sales that obfuscate what's actually going on underlying. The more you can take information from the blue line and add it to the forecast to the black line, the more you can increase your probability of being right on getting these bigger moves right, which is where all the money is made.
Yep.
There's trading opportunities in nailing these moves, but quite frankly, you'll confuse a lot of investors if all you did was focus on the blue line, which unfortunately, for the fact of the matter, most investors tend to do that.
Yeah.
Certainly most economists do. So we want to be one step ahead of investors and several steps ahead of most economists. So focus on the black line, take the information from the blue lines, and add it to your forecast. That's all it is.
That's a great point. So if you go, this is 2013. This right here. Okay? That was very blue. That's why we have so much credibility. And at the end of 2012, this was happening. So this is 2012. Mm-hmm. This is the US GDP cycle. 2012. This was happening. And we got that right. So there, literally, if you're subscribing to us then, you would have been shorting bonds, shorting gold, and buying growth stocks, okay? This plays out into the middle of last year with the latest cycles peaking further out into the year, which would include healthcare, financials, and consumer discretionary, which are now the 3 worst sectors in the S&P 500 because they were the last ones to go up, okay? So that, from that point, wherever you were in Q3 of 2015, if you started to risk manage your portfolio appropriately, like we told you to, you didn't get run over in August, for example, of 2015. You didn't buy the highs of November, December of 2015. You didn't do any of that because you basically were capitalizing on this part of the cycle, which is 2016. Okay? 2013 is not 2016. We wouldn't insult your intelligence by debating otherwise. But again, this big move and this big move is really what Darius and I are uniquely focused on. We'd say uniquely because we're the only firm, literally the only firm to get both of those moves right. And it's not, I'm not trying to brag about it. I'm just trying to teach you why. I'm trying to teach you why we've been accurate. I think it's important to study accurate and successful business plans, coaching systems, risk management systems, and fortunately, we've spent a lot of time and effort in our careers to give you something that's better than the alternative. I'd say it's just good flat out, but it's been a lot better than the alternative.
Healthcare has been brutal. Do you expect this to continue from a macro style perspective? And then the second part that kind of feeds into that is how far are we into the ACA taper theme? So just quick background on the ACA taper theme for those who are unfamiliar. We came out with this theme about just over a year ago, basically quantifying the impacts of the Affordable Care Act with 25 plus million newly insured hitting the market in a compressed period of time, about 6 months, all who are chronically uninsured and consumed a ton of care, very high acuity individuals in a short period of time, which was really a huge shot in the arm to all these healthcare companies across the board, and it had multiplier effects. I think if you look at all the hospitals, for example, we saw same-store adjusted admissions go to levels that we've never seen previously, and now we're starting to see that mean revert. So in terms of where we are into this ACA taper theme, probably in the 4th or 5th inning here. We're really starting to see it come through in the numbers so far in Q3. As Keith mentioned, healthcare has been a huge underperformer. If you look at our list of longs and shorts, we have, our short list is long and our long list is short, right? Because we're just so bared up on the sector and we think you just short everything. You had LabCorp report yesterday, the first negative utilization number on an organic basis in almost, I think, since 2012. So things are really starting to crack here, and the perception that healthcare is defensive, while true, it's we're in this environment where the ACA taper is really taking hold, and it's definitely starting to flow through the numbers, and we're seeing multiple compression as a result. So yeah, 4th or 5th inning, probably going to play out through the first half of 2017 at a minimum. But in terms of tracking the data on our side, it's definitely been longer to play out than we would have expected to. So maybe we're actually in the 3rd inning, but that's kind of where I think we are. Great.
Actually, I'll give you, just because I want to make sure everybody's clear. Sine curve, what are we looking at this morning? We're looking at GDP. Okay? I had a lot of people in Texas tell me that. They say, you got to keep taking it up a notch. I know what you're going to say next. No, we just got to review. Just like my son every morning. You got to go brush your teeth, man. He's like, I know, but you haven't brushed your teeth, so let's brush your teeth. Plus 3.3%. That was Q2 of 2015. What's GDP done since then? It has slowed. Now currently it's at 1.5%. Okay? The next part of the story here. It's from 1.5 to 0.7%. That's where we're at in the next 6 months. Okay? Simple? Andrew, is that simple?
Yeah, makes sense.
You're not going to 2.9. 2.9 is a quarter over quarter number, okay? So just so we're clear, GDP is reported on a quarter over quarter sequential. Ask your grandma and grandma's friends if they know what the hell that means, because it doesn't really mean a lot. Okay? That's the 2.9. What really matters is the year over year growth rate of GDP, which is this. Okay? So again, when you do get one of these high sequentials, it only raises the probability that the next sequential, as you fall down here, is a train wreck. So again, you're going to have a new president, you're going to have a Federal Reserve rate hike, and you're going to be here on GDP within 3 months. Okay? Because we're in the 4th quarter currently. The Q3 number no longer matters as of now. It probably didn't matter as of this morning anyway, because it was already baked into the cake in terms of how assets had been trading. The better debate is actually how forward-looking is the market? Is it 3 to 6 months? Probably. I'd go with that. I usually do. But again, a lot of people wouldn't invest today based on Q3's GDP number, which is 1.5%. What they would have done at the beginning of the year if they knew that GDP was going to go from 3.3 to 1.5 was they would have bought bonds, utilities, and gold, which you, of course, did. What is ACA taper? What does that mean?
Yeah, I mean, it's basically we're comping a ridiculously difficult comp that's going to bleed out over an extended period of time. That's
being the Affordable Care Act. Was
yeah, so you have an insured population growth that grows at 1 to 2% around GDP, and then all of a sudden with the Affordable Care Act, you have 25+ million newly insured hit the market all at once. That results in a very quick acceleration in the insured population to 6 to 8%.
That's the chart, actually. Josephine, show that chart while he's
which is almost unheard of, right? I mean, it's just never happened in the history of ever.
Look at that chart. Healthcare employment.
Yeah.
Look at that thing on the left.
And so that's not surprising, right? If you have a huge acceleration in the insured population, you need more people to service those, the newly insured. So healthcare employment goes up and to the right. And now we track all these metrics: job openings, admission trends, employment, PCE, et cetera. And what it's clear is that the data is deteriorating. It's slowing on the margin. So you have the healthcare universe, the XLV that's up on a rope. If you pull back a chart of like the last 10 years, it's remarkable how extended it is. And all the underlying metrics that we track, the macro factors too, are just equally as extended. And we think that we're going to mean revert in a big way, right? And we're on the other side of the waterfall.
Yeah. So let's show that. I mean, so again, just take this one out for a second. We'll do again. ACA is now going to be our sine curve, the Affordable Care Act. The chart, which is on slide 49, goes like this. Okay? Go back to that chart for a second, Josephine. The chart on the left, see that? See how it goes? That's straight up, okay? So what Andrew says then, again, this is very green, very hugely green. Does that look green to you, Carl? Yeah. That's pretty green. That's called a parabola. Then all of a sudden, the rate of change data starts to go like this. That, my friends, is why you're short healthcare. Right there, that little critter. That rate of change data going from, oh my God, this is so awesome, that you have to compare against. That's why Andrew said the comps equals compares. The compare against this period is unprecedented in healthcare history. Anything, almost any option, when you compare against that, you'd be short that option, or you'd be buying puts on that option. So that's why healthcare is even worse than the financials this year, which is pretty bad. We're looking at the economic cycle. So this is called a sine curve. For those of you that are new to this, you know what that is. I don't want to insult your intelligence. But again, cycles move on a sine curve. So again, when growth in the US was accelerating, that's an acceleration in rate of change terms. Not that complicated if you took calculus, and again, that's 12th grade math. If you're really smart, you probably learned it before that. But again, this is called accelerating. That's when I want to be short bonds. Bond yields go up when growth accelerates. This is when the economic cycle peaked. 3.3% year over year growth in 2015 was the peak, quarterly peak. Now we're down to, decelerating. When you had a deceleration in growth, we said buy bonds. So and we're at around 1.5% year over year now, going towards zero. Okay, that's 0%. This is the bull for the bond. This is the bear for the bond. Got it? Long term. So again, for me, Trump doesn't change the algorithm on growth slowing. I could be totally wrong on that. History would say that would be a bad bet for me to go against the curve or the rate of change of growth. There are a host of reasons why people sell bonds. Not the least of which are, oh my God, they just went down. I'm scared of it. I gotta sell low after I bought high. That's what a lot of people do. I don't have that reputational problem or that problem in my personal account. Again, we told you to buy bonds a long time ago when yields were a lot higher. So again, I understand that bond yields can go up, but they can go up for a lot of different reasons, including what I just pointed out, which is all these data points that happen in here that are like this. The faster you go into the bottom, see how many data points we can get? We can actually go like super, super fast, right? That's what the market's going to do today. That's what volatility is. But again, as those data points come out, you have to take a step back and you say, do I have a process? Do I actually, or did I ever know what was going on all along? Did I have an idea that there's a lot of Americans that are hurting right now because the economy is slowing? Did I have a clue that all this Fed policy, which created the highest cost of living in U.S. history, pissed a lot of people off and they might vote against 4 more years of the 8 that Obama gave you? I mean, do you have anything in you that changed this morning? Or do you have a process that takes out all the politics associated with that And all you're really trying to find is the economy accelerating or is it slowing? And you can tell me today, and it's not about how you feel about the economy, it's what the economy is actually doing. And again, we measure and map 30 data points in a predictive tracking algorithm every single month, 90 data points per quarter to get to these numbers. And again, we're tracking in here right now, 0.5% and then minus 0.7%. That's the Q4 and Q1 US GDP, okay? That's my outlook. Those numbers, it's all in here, okay? So that's why if you haven't owned bonds this whole time, what a wonderful day. You know, if you're one of these poor people who have been shorting bonds for the last 2 years, poor, like you'd be relatively and absolutely poor. This is like, might be your last chance.
Yeah.
But again, I'm gonna wait and watch because there's so many different things that can happen today. I'm not brave enough or dumb enough at this stage of my life with gray hair and 4 kids to just throw a bunch of money at the wall because I'm going with the same playbook I've had for 18 months. Today, the plan is that the plan changes. Please respect that reality.